You are listening to Keystone's Stock Talk Podcast, episode 160. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have one final show to close out 2021 and ahead of our 2022 predictions show, where we review last year's predictions and make some bold predictions for the year to come. In this show, we will review our recently released special report that included a review of every NASDAQ-listed stock with a market cap of under $2 billion, which is over 3,000 stocks. We will also briefly look at our just released Canadian tax loss selling report. In our Your Stock Our Take segment, first Brennan reviews Skylight Health Group, symbol SLHG on the TSX, a multi-state primary care group in the U.S. The company has produced strong revenue growth in 2021, but a lack of cash flow appears to be sinking this once high-flying small cap. In our second Your Stock Our Take, Aaron reviews a listener question on Algoma Steel Group Inc., symbol ASTL on the TSX, a Canadian producer of hot and cold rolled steel sheets and plate products. The company, which recently became public once again, has seen profits soar on higher steel prices. Aaron looks at the sustainability of this profitability. I'd like to welcome my two co-hosts again, Brennan and Aaron. How are you two doing?
Doing great. And
Merry Christmas. Merry belated Christmas.
Yeah, happy holidays, and looking forward to the new year.
Yes. 2 days away. It would be great to get into a new year. Hopefully this year looks a little different than last year. But Aaron, you just came back from a trip. A little vacation, took the family down to Disneyland, I believe, for your girls the first time. Must have been somewhat magical.
Oh, it was, for sure. So earlier in December, just a little bit before Christmas, we decided to pop down to Anaheim and do a Disneyland tour. So this is the first time. I went to Disneyland when I was 15, 16. My parents took me. My girls are much younger. They're 4 and 7 right now. So good time for them to go down there. But no, I thought it was a great experience, and who knows what 2022 is gonna have in store for us, and if we'll be able to do any traveling. So I took the time to do it.
The question I'd say, can I say that? Do you want to buy stock in Disney now?
Yes, to be honest, that is the first thing. Like Disneyland is so, and I've been to amusement parks in several places around the world, and Disneyland is just, they're so next level with what they're able to do. And I mean, some of the rides were just, they're not even rides, they're just experiences. And especially if you're a Star Wars fan, what they've been able to create there is just absolutely,
and Marvel, Avengers now, right?
All of that, like so much of it is just such next level, and the kids were loving it. And it did make me, because Disney is of course a public company, I'm a subscriber to Disney Plus, which once again, so that's Disney, Pixar, Marvel, all of that content. And it's really got me thinking again about, Disney as an investment. So it was hit hard financially during the pandemic, not from a share price perspective, but certainly financially. And it's a couple years before Disney Plus is expected to be profitable. But when you look at just like what that team, that network of people are able to do creatively to generate these experiences, it's from an investment from a consumer perspective, it's great. From an investment perspective, it's compelling. But of course, it ultimately comes down, when I'm looking at it from the perspective of an investment, it comes down to, the financial fundamentals of the company. It all has to translate into solid cash flow and earnings. If not, right aways than, in the near future. So who knows, in our US research, you could see Disney poke its head in there.
Yeah, well, I mean, I remember back in the day, the purchases, I think it was off the top of my head, I think it was a $2 billion purchase of Marvel. And I remember people kind of shaking their heads at the price tag that they paid for Marvel. And today, almost every Marvel movie makes $1 billion to $2 billion in terms of box office receipts unto itself. Put on top of that all the merchandising, all the everything that goes around that, and the theme parks have rides based off of that. It was an absolute bargain basement price they paid, and what they've created from that. Same with the Star Wars franchise too. I mean, it's unbelievable what they've been able to do.
Yeah, $4 billion they paid for Lucasfilm, so Star Wars, that was
Lucas, and then Marvel. Yeah, look it up and see if it. I think the $2 billion was what I remember, but look it up and see if it's in that range. But I mean, that was years ago now, obviously.
Marvel
but it's
Entertainment,
unbelievable.
$4 billion as well, it says here.
Yeah. So I guess I was a little under, but I mean, when every movie is doing $2 billion or $1 billion, it's unbelievable, really, the price and what they've been able to create out of that. But I've got a 6-year-old, and we've been down 3 times, and if there was no COVID, we probably would have been down 2 more times. So. We're looking at potentially, pending whatever goes on this year. We're going down for a research trip. The 3 of us will be going down to California, and, I may take the family down there before and just, spend another 3 days in Disneyland. And you certainly drop a lot of coin there.
This is research, though, right? Because
I'm going to Disneyland for research. Yes. That's the only reason that I go to Disneyland.
And you have to add Brennan in there. You have to say, I'm bringing the family.
Actually, Brennan may come. Brennan's never been.
No,
I forgot to say.
yeah.
Brennan, who actually lives in a hobbit hole or something in Saskatchewan. I'm sorry, man.
That's okay.
Brennan's enjoying minus 35. Yeah, minus 35, minus 40.
I'm
Brennan's
sorry.
a machine. Come on.
Yeah.
He
is a machine, but we need to get him to Disneyland so he can talk about this, right?
Exactly.
Right, Brennan, you're at least, if we're going, you're going for at least a day.
Oh yeah,
I'm gonna drag you there, and you're taking Eden around on every ride. Okay.
Oh, you won't be dragging me there because I'll be very, very happy to be there and to get to relive my childhood a little bit. Like I was gonna say, my parents kind of robbed me.
You gotta get out of your childhood before you go back and relive it, Brennan. Come on.
Fair point.
All right. Anyways, I'm glad you guys had a good trip. I loved hearing about it because I do. It's fun down there, and like you see it through your kids' eyes when you're down there. It's pretty awesome. So I will actually love going again. I'm sure it'll be good times.
Can't wait.
Now let's look at our first special report. We put out a couple just right ahead of Christmas. This is the first one we'll look at is our NASDAQ under 2 billion small cap market report. This report, individually reviewed, our analysts did about 3,500 NASDAQ, primarily NASDAQ listed stocks with market caps of under 2 billion US. Now, the impetus behind this whole project was to really just get a better understanding of the current valuations of this group. We increase our analysts' general knowledge of this set of companies and create a group of over 100 stocks, essentially in that range, which have a threshold level of GARP or growth at a reasonable price, the criteria that we identify, like to identify near and long-term investment opportunities through. The research going through all those companies, it produced a list of around 130 stocks from which we have provided in the report statistical analysis in our tables section from the initial numbers and our review of these businesses that we looked through. We produced a list of 38 stocks that we provided mini reports on that detailed the businesses, their current valuations, and their merits as potential recommendations upcoming. The report itself produced 5 recommendations, 8 updates from companies currently in coverage, and 7 stocks in what we'd call our top tier monitored list, or stocks we are looking to potentially add to our buy list over the course of 2022. And there's 19 stocks in our standard monitor list that we'll monitor quite closely. I'd say what struck me from doing this research, and when I look at the entire report, is the diverse range of companies that are covered in this report. And that just stems from the kind of the diverse range of companies that you find, the breadth of companies that you find in the U.S. markets generally. I mean, there's everything from gold and precious metals producer. We recommended one company in that segment. SaaS businesses, there's REITs, semiconductor manufacturers, retailers, e-commerce companies, enablers, there's payment processors, hardware manufacturers, biotech, healthcare providers, basically everything in between that. So a huge breadth of companies to choose from, which is great to see. It's a difference looking at this market when compared to the Canadian market. And I'd like to get your comments on it because you guys did research into this report as well.
Sure. Well, we've always known, I mean, obviously the US market is much larger than Canada, but what we've also talked about a lot over the past years is just how much more diversified it is down there, where there's such a focus here in Canada on commodity related businesses, resource related businesses, and then the big banks. In the US, they have a great technology sector. I mean, their technology sector is absolutely massive. A lot of different companies touching a lot of different areas, industrial, infrastructure, just a lot of different types of companies that really make the market interesting. And of course, there's very interesting companies up here in Canada as well. It's just, first of all, a smaller market. And then when you strip out, the big six banks and then the resource companies, most of which we're not interested in. Most of the resource companies in Canada are not even producing revenue, never mind profitability. But when you strip out resources, you strip out financials, you're dealing with an even smaller market up here in Canada. So it's really compressed.
Yeah. And then if you try to look for growth at a reasonable price in those companies, it really compresses.
Yeah, exactly. And it also makes looking at the market valuation overall in Canada really, it's more or less, it's not a very helpful figure to look at because there's such a range, right? From your highly cyclical commodity businesses to your financials to your, standard conventional operating companies and growth stocks. So just more, I mean, it takes a lot longer when you have 3,500 companies in Canada, which is, most of the market, almost the entire TSX venture and TSX, we're able to get through a lot of those fairly quickly because they just don't even pass the minimum criteria. Whereas when you're doing a screen like that in the US, it takes a lot longer to get through the companies because so many more pass that minimum criteria. They don't pass the full criteria necessarily, but they warrant further research. And so it slows the process down. But, there's things, I mean, obviously, when you look at the technology space, software companies with high recurring revenues, particularly in that mid cap range or small cap range, you're generally paying very high valuations. There are some exceptions, but you're generally paying very high valuations. There is value in the market, in other areas in the market, but it's when you look at a market environment like we're in right now that has been largely pushed by high growth companies. And then you look at other investment classes like, say, Bitcoin and other areas that have done really well. It really makes the value opportunities look less interesting because value is a long-term strategy. It's not, something you necessarily should expect to get a big return from in 3 to 6 months. But for people that do appreciate value, companies that are trading at a lower price relative to the underlying earnings and cash flow, there are opportunities there. You just have to be more patient on, getting that investment return out of them, and having the market recognize that value.
Yeah. I think one of the things Aaron pointed out there, that when we're looking at 3,500 companies, for example, in the US, there is more to dig into in these businesses. It's good. It takes longer. I mean, we started in September looking at these companies, so you can see it takes months to go through that many. But of note over that period, when we're compiling this report, and we kind of noted this in the introduction, was the valuations in the US and Canadian, particularly the micro, small, and mid-cap markets, which would be, under $2 billion certainly in the US. They've shifted significantly lower, and it's kind of been underreported, and we call it like a stealth correction or stealth sell-off. Well, you see the NASDAQ is significantly in positive territory for 2021, but over 37% of NASDAQ stocks are now down 50% from their 52-week highs. The FANG stocks now make up almost a quarter of even the S&P 500. and are masking a rather significant correction in the rest of the market, essentially, particularly in this micro, small, and mid-cap space. So I would say, despite the correction, generally in this space, valuations on a historical level are elevated to a degree, and it should give readers, or listeners today at least, an idea of the extent that we saw irrational valuations heading into 2021, and particularly when we saw a jump up in the early part of 2021. Now, there are certain parts that we noticed during this compiling this report that value may be beginning to appear in certain segments, but I would say, being cautious, broadly speaking, right now is not a bad thing. Finding the value and looking 1 to 3 years forward is what we are looking at right now. And there is some value starting to creep in, but there are some segments of the market still that are trading at these elevated valuations. And when we did presentations in December, we talked about, I talked about a company like DocuSign. We talked about this on the last podcast. Good company, good business, had good growth. Slightly missed earnings, and in 2 days the share price was down roughly 50%, and that is a high flyer that everybody wanted to add to their portfolio over the past year. But the valuations on a price to sales basis, just not a price to earnings basis or price to cash flow basis, got to the 50, 60 times, and just one little misstep, and a company like that is really vulnerable to a correction. So I would expect, we've seen quite a bit of that already since the fall of this past year. You may see more of that to start the year as well.
Yeah, one thing that I'd like to add too is just, going through all of these companies, we read, I probably read myself over 50 conference call transcripts. And, one thing that I picked up, especially from our, top tier monitor or the companies that we are monitoring, some of these companies are, going through headwinds with cost inflation, which are going to squeeze margins a bit, as well as, there's still a little bit of a lag and continued pressure from COVID lockdowns. So it's, interesting, like Ryan was kind of saying, being patient, monitoring these businesses closely. Maybe it will create an opportunity, especially if we all of a sudden see, the margin contraction starting to, wane or wear off, and potentially just seeing some momentum in the business, and maybe having some opportunities present themselves into 2022. So I'm excited to monitor some of these businesses closely as well. And
and I'm really excited. There's, like I said, 130 plus companies that we have basically on a monitor list, and whittled down even that to just under 40 that we really want to watch closely. There's a number of the teams that we've interviewed already, some of them that we'll interview in January, and we believe it's going to produce further recommendations going forward. There's some businesses that like Brennan said, they're highlighting some short-term supply chain issues, some short-term labor pressure potentially, and how they navigate those in the first half of the year is going to be very interesting. What we have is a really good monitor list in this segment right now that if we see some, they're good businesses. If we see a correction of 30%, we might be able to get some bargains, whether that be, the first part of the year, the second half of the year, or the end of the year, or whenever during the year. I think there's going to be some good companies that we can add and probably get them at a better price.
Yeah, so we have within the report, you talked about narrowing the field down. So we have a top tier monitor list from those 3,500 companies of 7 individual stocks. So these are companies that would be very close to recommendations, I would say, over the next month or so. And we'll be looking at them, as you said, Ryan, and there could be another 1 to 2 recommendations that come out of this report in the next several weeks.
Yeah, that's what we're looking for sure. I'm going to briefly shift gears and touch on, we also, for our Canadian small cap clients, that was for our U.S. growth and value stock clients, we did that report. We finished a tax loss selling report. I can just touch on briefly what tax loss selling is, why we think it's a strategy you can use, and then we can have a quick discussion. Then we'll move to our 2 U.S. stock, our takes. So tax loss selling itself and the strategy to take advantage of potential opportunities that may arise due to tax loss selling. It's not specific to just this year. It can be used every year moving forward, and that's what we noted in the report. So what is it and why is it done? Well, the praxis known as tax loss selling or tax harvesting, it involves selling investments in a loss position to offset capital gains realized by other investments. So just a quick example. During 2021, you sold shares in ABC stock, TSX, listed for a gain of $1,000. You also sold shares in XYZ on the TSX for a loss of $1,000. So you got $1,000 gain, $1,000 loss. The net effect is that they offset each other and you pay no tax. Now, let's look at it in practice. I like to give real world examples. So let's give a significant gain from our portfolio over the past year. Be Photon Control. This is a stock that's been in our focus buy portfolio for 5 or 6 years since it was trading at 46 cents. We also re-recommended it in March of 2020 at 88 cents. So midpoint through this year, it was acquired by another public company for $3.60. Those gains would be between 200 and 700% roughly for clients. That's a great thing. But of course, it triggers a significant tax consequence. On gains like that, you should never begrudge paying taxes. Capital gains are far less on what you would pay in terms of regular income, so they're treated far more effectively. But if you can offset those gains with some past losses and reduce tax or some losses you had this year, why not do that? That is where tax loss selling or harvesting comes in. So what you want to avoid is you never want to sell a stock just to create a loss. While you may want to avoid the taxman and offset gains during this year or next year, a decision made just to avoid taxes without thought to the underlying investment is poor investing strategy and can often be regrettable, costing you more in the long run. I'll give you an example of that. I think it was September 2017, we recommended Expel Inc. and it was trading around, $1.45. $1.50 in that range. Now, it went as low by the end of the year as about $1.30, $1.25. And if you would have said, I need a small tax loss to offset a gain in another company and sold those shares, well, within 3 months, the company had doubled. Within 6 months, it had basically doubled again. Today, it's in the $70 range. You do not want to base your criteria for selling in terms of tax loss selling, to sell a stock just to create a loss. Do not do that if it's sitting in a loss position. Evaluate the company based on its fundamentals. If those fundamentals aren't there anymore, that is why you sell. So when to use tax loss selling? Take advantage of tax loss harvesting only in stocks that you're already planning to sell as a result of your ongoing, and this is what I was talking about, investment criteria or strategy. That should include selling businesses where the fundamental criteria for the original purchase of the stock has changed, including deteriorating financials, strategy change, management change, these things that you'd like to sell. Do not sell good businesses that trade at a loss just to reduce a capital gain in 1 year. So what is the opportunity? You want to take advantage of irrational selling in a given year in that December period. Investors with an eye to reduce taxes sell shares in companies indiscriminately. They essentially do just what I was saying not to do, selling shares because they're in a loss position with no mind to the current value of the business. While not always the case, this can temporarily depress the price of good long-term businesses. That's what we're looking for. So your goal should be buying good businesses with reasonable financials that face tax loss selling. These are the proverbial babies that get thrown out with the bathwater. What you want to avoid is poor businesses. Companies with declining to no financial position that face tax loss selling. Remember, just because a stock was at $30 earlier in the year and now is at $7 today does not mean it's on sale. Many stocks will be sold during tax loss selling season every year for very good reason. They are crap investments. That $7 stock that was at $30 is not necessarily on sale if it's a poor business. It can easily drop to $3 this year if it continues to underperform. So that gives you a good synopsis of what we will look at in the report. We came out with some companies that we're monitoring and a couple of opportunities that we think right now suffered some tax loss selling, have good, strong fundamentals, and are positioned for a good, strong earnings growth over the next 1 to 3 years. And we took advantage of some of those with that report. So you guys got any comments, or do you want to move on to our Your Stock, Our Take?
Brennan?
Well, I think just
Brennan fell
overall,
asleep.
no, I didn't fall asleep. I thought it was good. I thought it was a very timely for the report, especially because, speaking in terms of my own portfolio, I've learned over the last year that I need to own more large cap rather than small cap. So that definitely was the case. I saw a lot of blood in my portfolio, still great businesses, but, it was a very timely for that report. I won't say the name of one company that you have as a monitor in that report, but again, I'm touting the monitors. I am very excited about this one company. It's essentially a MarTech or marketing tech company. It's just breaking into profitability. Looks pretty interesting. Want to keep a close eye on that stock, and we'll see. Maybe it will potentially be a recommendation in the future. But yeah, I guess that's basically all I got.
Right. And then I just want to point out, absolutely timely information, great report. I just want to point out, as you said, Ryan, it's not about pursuing a strategy of tax loss selling or buying. It's about there being a certain point in a time where there could potentially be a couple of opportunities to take advantage of indiscriminate selling. So I think that you highlighted 7 companies in the report, right? So this is out of, a universe of potentially hundreds or a couple thousand companies that you could have picked from, but it's 7 companies that you're highlighting, and we're not buying them or selling them because they go down. We're looking at these companies as business owners and making our decision from there, whether or not it's something we want to own or not. And that's always the way that we conduct investment analysis.
Of course, yeah, and it's good to, again, tax loss selling is a tool in your toolbox. It's not the be all, not the end all. There can be some unique situations every year that can develop. It's something to watch every year, and we'll likely have a similar report next year that we can see some companies that may be in a position to take advantage of this situation. But again, we're not going to buy a business because of tax loss selling season. We're going to have eyes on that business probably for 6 months or a year ahead of that, find it as an opportune price at that time, and then want to hold it for 1 to 3 years. Not want to hold it for a Santa Claus rally into January or anything like that. We want to hold it because it's a good business. We may have just found it on sale during that period because of some unique circumstances that surround some tax loss selling. Now let's look at our first Your Stock RTAG. It's time we answer a question on your stock in a little segment we like to call Your Stock RTAG. Buy, sell, or hold. Brennan is going to review Skylight Health Group. I'll let you take that away,
Awesome.
Brennan.
You bet. So this one came in from Andy, and this is what he said. He says SLHG, which is the ticker of Skylight Health Group. He says, it's since moved to a 52-week low. Curious to hear your thoughts on why. So let's take a look. So Skylight Health Group, again, SLHG on the TSX Venture Exchange, currently trading at a price of $1.74 and has a market cap of about $70 million. So Skylight Health operates a U.S. multi-state primary care health network comprised of 24 medical clinics, providing a range of services from primary care, subspecialty, allied health, and laboratory and diagnostic testing. Now, the company is focused on shifting from a traditional fee-for-service model to a value-based care model through its proprietary technology, data analytics, and operations infrastructure. And just to give a little bit of insight into this, the company notes that in a fee-for-service model, payers, who are the commercial and government insurers, reimburse on an encounter-based approach, which puts a focus on volume of patients per day rather than creating positive patient outcomes. So now the company wants to focus more on a value-based care model, which providers are rewarded for keeping patients healthy and lowering unnecessary health costs instead of volume of services. And the company notes that VBC will lead to improved patient outcomes, reduced cost of delivery, and drive stronger financial performance from existing practices. So that was a mouthful, but that is essentially what the business is focusing on. So a few key points here. The company is growing primarily through acquisition, having made 8 acquisitions over the past 12 months, and they are essentially touting themselves as a white knight for fee-for-service primary care practices. And On May 28th of 2021, the company conducted a 1-for-5 reverse stock split. So following the split, they have about 38.8 million shares outstanding. And more recently, on December 7th, the company issued 5.8 million US preferred stock yielding about 9.25%. So, seeing companies, or especially these small cap companies, offer preferred shares, we don't love seeing that. But they do have some prefs now. So looking at the recent financial results for Q3 of 2021, revenue was up substantially, up 270% to 12.2 million compared to the same quarter last year. The company is still losing money with a net loss of 3.4 million compared to a loss of 1.3 million in Q3 of 2020. And adjusted EBITDA is also negative at 2.6 million compared to a gain of just 331,000 last year. The balance sheet looks reasonable with 5.6 million in cash, leases and debt of 17.3 million, providing net debt of about 11.7 million. And just quickly looking at the valuation multiples, management did provide 2021 revenue guidance of 41 million, which provides a forward enterprise value to sales multiple of approximately 2.1 times. And if we are to use the Q4 guidance and create a run rate off of this, we are looking at a multiple of about 1.6 times. So I don't think that these multiples looked bad, but the question I have is how long will the company continue to lose money? And then just one last note here. I did see in the company's presentation that they had some equity research coverage, a few firms with price targets on them. And I just wanted to highlight them because I think that they are kind of ridiculous. So Northland Capital has a price target of $9 US on the company. Lake Street Capital has a target of $8 on the company. Echelon Capital, $8 price target. Raymond James, $7. So you can see, these are very, very lofty. The company has negative profitability. Profitability is, getting worse and worse. How do they get to these valuations? Someone explain to me, how do they get to these valuations? Maybe I'll have Ryan touch on that.
Well, I think a lot of the time they're either paid research or they're looking to do a financing and want the company to be loving what they say.
As well as that this stock was actually at one point up around $9 per share. Mm-hmm. And I don't know how it could have got up there with such lack of profitability, but I do notice that a lot of times, like say when it's around $7 per share, an analyst puts out a price target of, maybe $9, $10, $11, then the company falls apart, in this case down to $1.70. It's a lot harder for the analyst then to turn around and say, I was completely wrong, and reduce that price target down to like say $2.50, $3. And this is one of the reasons why price targets, you should never get excited looking at price targets. I mean, at best, these are intelligent guesses because nobody can really tell the future. And sometimes they're much worse than that. But I'll turn it back to you, Brennan.
Perfect. No, I appreciate that though, guys. Good comments. So to sum it up here, to answer Andy's question on why Skylight's share price has reached a new 52-week low, I would argue that we are seeing a few things. Number one, most small cap names were decimated over the course of 2021 after a very strong rally in early 2021, driven by what I think was the meme stock exuberance. Now, number two, as these small cap names came off and a lot of people bought them at elevated prices, like Ryan just touched on, we started entering tax loss selling season, which more pain evidently followed. Now, focusing more on the business, number three, throughout 2020 and into 2021, we saw many healthcare providers and clinic operators that have a little bit of a tech side to their business receive tech multiples. Now, in the case of Skylight Health, 98% of their overall revenue comes from medical services. So over 2021, we have seen many of these ridiculous multiples on healthcare providers, which were getting, tech multiples essentially, come back to earth. And lastly, number 4, we need to see the business focus on profitability, where right now they're essentially just making acquisitions, even though some of these acquisitions are accretive, but we're not seeing the business work towards profitability. We really need to see that going forward. And eventually, as a company continues to lose money, market participants are going to, sell it off because they need to see that profitability eventually. So this is why I think that we are evidently seeing the new lows. So all in all, I think it's an interesting business, which is growing revenue at a great pace. It's neat that they are trying to disrupt the healthcare space with a value-based care system from a fee-for-service model. But I would like to dig deeper in understanding this model and potentially ask management how much of its total revenue is generated through value-based care right now. And, essentially the business trades with reasonable multiples, but until we see movement towards profitability and not into a larger deficit, it's a name that we would simply continue to monitor.
So do you have the figure on what their targeted revenue rate was, or not the run rate, the targeted revenue for this coming year will be?
I do not.
Like
I do
fiscal
not.
2022.
That's something that I should pull up.
Did they not have some guidance, or you said, or no?
I believe that you pulled up some guidance when you touched on it earlier this year. I didn't pull it up this morning when I was doing some analysis.
Because and do you know what they did this year in terms of revenue?
Well, they've only reported Q3. They're anticipating that they provided guidance for all of 2021 with 41 million. Yeah. So that's what they're providing.
Okay. I guess I'm just looking at a press release back in March, like early March, the early part of March, and they completed about 5 recent transactions, and they says their annual run rate is about 56 million. So, and I understand they did transactions since then, so it doesn't really seem to square off. I know that's a run rate, but the other part of it is they talk about all these companies, the transactions that they purchased being between 4 to 5 times EBITDA. Which is consistent, again, this is consistent across those transactions, and yet they are bleeding EBITDA and bleeding cash flow. And then they had a 10% EBITDA margin in 2020, and yet, they can't seem to even have a 2% EBITDA margin for the full course of this year. So again, that would be the reason to me. There's no positive cash flow. You can acquire. And if you don't ever create positive cash flow, plus it does look like overall this is a relatively low margin business. So it's not like we're growing at a high rate, or this business is growing at a high rate, and then they're going to start to bring in 20% or 30% EBITDA multiples. It looks like the 10 to maybe 12%, maybe what they are targeting. So how they got to that valuation at the start of this year, it's very curious to even think about. It's over exuberance for the sector, misunderstanding the business, and mispricing the business, in our opinion.
Yep.
So I just took a quick look while you were talking there at the recent press release. So there wasn't any guidance or run rate discussed there for the Q3s, but on the conference call, on the Q3 conference call, the management did say they would expect to see a run rate effectively at the end of this year of just over $40 million, or just under 41 million roughly. So that's more or less. But then in the question period of the conference call as well, it seems like they're not necessarily. There could be some one-time items in there. Really, what it comes down to mostly, as Ryan said here, is that they haven't proven the margin, they haven't proven the profitability, and the value-based care system. I mean, that sounds absolutely great theoretically, but what I would want to know is what is the business model specifically? I mean, how do you generate revenue on a value-based system as opposed to just providing services? So great in terms of a strategy for the healthcare industry overall. I don't know how an individual business really executes on a business model like that, but that would be a question that I would have if the financials were more interesting. They're not, so I probably just wouldn't even bother asking right now.
Excellent. Now, Aaron's going to cap off our show with a Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. from a listener on Algoma Steel Group. Interesting business. I'm interested to see what Aaron has to say. Now, this business has been around for quite a while, and it's just become public once again.
Yeah, so Algoma Steel, the symbol is ASTL on the TSX exchange, and it's trading right now at $13.40 per share. It has a market capitalization of about $1.5 billion. Algoma Steel is an integrated steel producer in North America. The company has raw steel production capacity currently of 2.8 million tons per year. And this is a company with a 100-year history of operations. It was public many years in the past, and it just returned to the public markets again recently in October of 2021, back on the TSX. So Algoma is one of those commodity stories that we've been receiving questions on recently from our clients as well. The stock right now is trading slightly lower than the $14.40 level it was at when it commenced trading on the TSX again, just back in October, a few months ago. But the performance has been good over just the last 5 trading days, up about 11%. I've taken a look at the fundamentals of Algoma. Fundamentally, it is an interesting situation. The financial performance in the most recent quarter, which is Q2 of fiscal 2022, was very strong. So let's take a look at those numbers. For the second quarter, shipments were up to 587,000 tons, a 13.7% increase compared to about 516,000 tons in the prior year quarter. Revenue was up 168% to just over $1 billion compared to $377 million in the same quarter of the previous fiscal year. The company reported adjusted EBITDA of $430 million for the quarter, and cash flow from operations were $380 million compared to negative cash flow of $56 million in the same quarter of the previous year. The strong performance in the last quarter was the result of higher shipments in the period, but also primarily due to a huge increase in average realized steel prices, which were up 146% to almost $1,600 per ton, compared to about $650 per ton in the same quarter of the previous year. Looking forward to Q3, the company maintains a positive outlook. They're expecting shipments of about 590,000 to 610,000 tons, up slightly from Q2, and adjusted EBITDA of at least $450 million. The company has an interesting strategy for growth. Algoma recently announced an investment to build a new electric arc steelmaking facility. This has the potential to increase annual production from 2.8 million tons to 3.7 million tons. The facility also has the potential to help reduce the company's carbon footprint by reducing CO2 output by 70% and helping to make Algoma a leader in the area of green steel. Algoma's board of directors also announced a plan to retire all of the company's outstanding senior secured long-term debt. So this would be a debt reduction of $358 million US. It would result in a very healthy balance sheet with low debt leverage and save the company an estimated $8.3 million US in quarterly interest payments. And then valuation, very attractive based on the current numbers. Algoma produced about $450 million in free cash flow over the first 6 months of this year. At the market capitalization of $1.5 billion, this is a price to cash flow multiple of just over 3 times based on only 6 months of free cash flow. Now, if we were to annualize the free cash flow, it would result in an incredibly low valuation multiple for the stock. But of course, there are some clear risks in annualizing the performance of a company that is so commodity price dependent. Overall, I think that the fundamentals on Algoma are very interesting. The company is producing substantial amounts of free cash flow. They have a plan for growth. The balance sheet is healthy and the valuation is low. The key risk here is in the commodity price exposure. The price of steel, and more specifically, the price of hot rolled coil and rolled plate steel, are what will be the primary drivers of financial performance and cash flow for Algoma. There has been a massive increase in the price of steel from August of last year. Since then, prices seem to have peaked, but they're still at elevated levels. So in an environment where steel prices stay strong or even increase from here, there's substantial upside potential in investing in Algoma. However, the flip side to this is that if prices were to weaken significantly, then investors would be facing substantial losses. I think that the important thing to remember here is that investors in Algoma are largely investing in the price of steel. For those that are bullish on this commodity, or if you just want to add some commodity stocks in general to your portfolio, Algoma does provide a compelling investment proposition. But just don't get too caught up in the current fundamentals, the current cash flow, and the current valuation, because these things can change very quickly. You have to understand the risks of investing in a commodity stock like this, set your position size appropriately, and if you do invest in a company like Algoma, expect volatility in the near term. Any comments?
None for me, Ryan.
Sorry. I think I turned my mic off there, and I think I had a frog in my
put you to
throat, so I had to
sleep.
cough it out. But that happens, right? No, but I think it's a good summary on the business. And it really will come down to if you are bullish on the price of steel. Going forward, Algoma is going to do tremendously well, and the cash flow is going to continue to be at a high level. Valuations right now, valuations are always hard on these commodity businesses. You can have one quarter where they look like they're trading at 2-5 times cash flow or something like that, in that range, like really low valuations. And then the price of the commodity can fall off a cliff, and the cash flow can also fall off a cliff, and suddenly you're looking at the company looking at high valuations. So, you got to kind of look at a blended average over time to come up with a good multiple on the company. Right now, it does look attractive. It does look like it's trading at low valuations. That's pending the price of steel. If steel rises this year or stays in its current range, Algoma is probably going to come out with huge cash flow and and look like a good investment story. It could go the other way just as quickly. That's what investors or speculators have to know about Algoma.
And I am finding some of these commodity stories to be somewhat interesting, because through our research, I have come across several names. And in fact, in our income research, I recommended a company that has exposure to the copper space that's very interesting, very, very solid fundamentals. Now,
it pays like a 6% dividend.
It pays a great dividend. So now but I'm very clear with the information that these companies, they're really investments largely first and foremost into the price of the commodity, and at a secondary level into what those individual management teams and companies are doing, right? So the company that I found, it has a very interesting investment proposition for a number of reasons, even outside of just the commodity price, but ultimately the success or failure is going to be hinged to that factor, to the commodity price. Now, I do think that in the current environment, and this is something we're going to discuss maybe in the next podcast or the podcast after that, talking about inflation and some of the ways that people can position their portfolios for an inflationary environment. Commodities are one of those possibilities, although we caution people not to get too over leveraged to them. So we are looking at coming up with some ideas in this area. And then fundamentally, a company like Algoma, well, I love the strong balance sheet. I love that they're paying down the debt. Right now, they have great cash flow. So in a strong commodity price environment, they have potential to do very well. But if the commodity price goes in the other direction, you have to be prepared that there are going to be substantial losses as well.
Yeah, they can't dominate your portfolio.
No.
is what we're essentially trying to say.
Exactly. A portion of your portfolio invested in these types of companies, a reasonable portion is fine. But when somebody starts saying, I'm forecasting a commodity super bull market over the next 10 years and I'm now 90% in commodity related stocks, that's a recipe for disaster. It's more of a lotto ticket than anything else. If you want to play the lotto, if you want to gamble, go to Vegas. If you want to invest, think about what you're doing and manage the risk.
Yeah, for sure. I guess that'll conclude our podcast for this week. We're putting together our predictions show, likely next week for 2022 and beyond. Look back at some of our predictions, our funny predictions for 2021 as well. Should be a good show. Look forward to that next week. Keep your questions coming in for our Your Stock, Our Take segment. We'll endeavor to answer those each week. Ask Us Anything segment as well. If you want us to compare a couple companies, look at two companies in a similar industry, we can have a debate on that as well. As always, I'm going to wish you profitable investing, but this time I'm going to say Merry Christmas and a Happy New Year to all our listeners out there as well. Thank you.
Happy New Year's, everyone, and profitable investing.
Happy New Year. Thank you.